Hello, everyone. Thank you for making time in your busy schedules to be here with us today. This CE-accredited financial planning session is about how Snap can make things easier for your practice and better for your clients. Today, you will see how transparent and efficient financial and retirement planning can be when you partner with Snap. You will see that we can build highly personalized financial projections in minutes, not hours, and that we can easily answer your clients' most important questions. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague, Steve Arnott, Snap's financial planning project lead, who will provide today's demonstration and run the Q&A.
Hello, everyone. Thanks for joining us.
Great. So before we get started, I'd like to do a quick tech check to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your Q&A tab? This is exactly how you'll send any questions you have throughout the session. I'll be using the chat tab. Any messages sent that way are typically public to everyone. So for private messaging directly to us, please use the Q&A tab. Can we see any of those coming in, Steve?
Yep, looks like we're all good. Thanks, Ryan, Lawrence, Skylar.
Fantastic. Looks like we're all set. So please make sure you stay until the end to hear about the special offer. And of course, to make sure you are eligible for your CE credit. Steve and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. Okay, so for those of you who aren't already familiar with Snap, Snap is a Canadian financial planning software platform. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you want to hear from other advisors who are already using Snap, you can find reviews numerous places online. For example, on Capterra, which is an independent third-party software review site, you will find advisors saying things like none of their clients retire without a SNAP projection and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for over 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with Snap to grow their assets under management and increase quality referrals. After this session, if you are curious about specific use cases for targeted planning needs, such as insurance planning or tax planning, please visit snapprojections.com and under the Use Cases tab, you will find what you're looking for. We are pleased to now be providing comprehensive French language solutions, which includes the software in French, as well as customer support and product demonstrations with a French speaking team member. So let's get to it. I'll start with introducing you to today's case study client, Melissa Gill. Melissa lives in the beautiful province of British Columbia and plans to retire in just 10 years. Melissa has questions for us today, and these questions are pretty common and standard for pre-retirees. What do you think her questions might be? Over the last decade, our research has continued to find there are 6 main questions and concerns your clients want answers to. The $1 million question, am I going to be okay? Essentially, what they're asking is how long will my money last? They need to know how much they can spend so they won't run out of money. They need to know when to take their government benefits. They also want to know which order to start drawing down their assets. For younger clients, they need to know if they're saving enough. And then they also want to know how much will be left after taxes for their beneficiaries. Snap has been designed to easily answer these questions for your clients and more. and to show them their options. That's exactly what we're going to do for Melissa today. One of the ways we will be able to address questions will be to use the scenario comparison module. When a client has a what if question, we can use this chart to show the net difference of potential choices. We can compare up to 5 scenarios on one page or select just 2, which will automatically populate the third column showing the difference between choices. Another tool we're going to leverage will be the snapshot, which is your one-page financial plan summary report. This can act as a standalone client deliverable and makes a great meeting review template. It's an opportunity to highlight specific items for your client and ensure their most important questions have been addressed. This allows you to share the information that matters without creating overwhelm or confusion. This snapshot here is Melissa's, and as you'll come to discover, it's an automatic output that's created from the projections without any additional work. Steve will start with showing you the basic profile setup in Snap Projections. To run a simple projection and answer some basic questions, we just need to enter a few data points. Name, date of birth, province of residence, income, current asset holdings, and any planned contributions. That's it. With Snap, we can be quick and simple, or we can conduct comprehensive planning. You can sit down with a client or prospect, enter a few data points, and create basic projections that are highly valuable within 10 minutes. For prospects and many simple client cases, this may be as far as you need to take it. When you need to go deeper, Snap has you covered for that as well. So I'll get Steve to take over now and log into Snap.
Terrific. Thanks, Alex. And thanks again, everyone, for joining us today. Snap Projections is a web-based platform, so you can access your account from any Chrome browser on any computer without the need for a download. You'll go to snapprojections.com, and then in the top right corner, you'll have the option to log in using your username, password, and the option for a multi-factor authentication. I've entered that during today's session, so I'm taken directly into the software. From here, I can access any of the previous projections that I've created, or I can get started on a new client file. Before we jump into the software, I'm just going to highlight those 2 documents that Alex walked us through. The first is the 6 questions. We'll be coming back to this throughout today's demonstration to show how you can answer each of these questions using resources in Snap. And then the second is the financial snapshot that we're going to create for Melissa. So we'll go from data input all the way to this customized one-page summary in about 30 minutes time. And we'll show you how to optimize plans along the way and how to make sure that the final deliverable that you provide to your client is actionable and in their best interest. With that, we'll go back into the software, we'll click Add New Client, and we'll start entering in the information for Melissa. So we have Melissa Gill. She was born in 1976 and currently lives in British Columbia. In the top left corner of the software, you'll see that there are 3 main sections to the tool. The first is this scenario setup, where you enter in all of the base client data. This includes things like the client information, general plan settings, expenses, incomes, assets. Once we're finished with entering in all of our base data, we'll then proceed to the planning pages, where all of this information comes together to show us Melissa's life on one page. From here, we can review information, make any updates that we want, and then once we're comfortable with all the numbers, we can proceed to the client report, where we can select the charts, tables, and commentary to include in the final deliverable. For now, we'll continue on with the scenario setup. I'll click Next at the bottom, and we'll go to the general plan settings. We'll begin the projection this year with a target retirement age of 60 in 10 years' time, and we're going to run the projection until age 100. The inflation rates have been pre-populated using the most recent FP Canada guideline assumptions, and then we've adjusted those gross return assumptions to account for any management fees to arrive at a net return assumption in the software. There's lots of flexibility for entering expenses in Snap. You can leave this page entirely blank and have Snap help calculate what the client's current spending is or what their future spending would be using a sustainable approach. Or if there's a target already in mind, we can enter that information in here. So Melissa is hoping for $60,000 per year, net of all other costs. So this is net of debt payments, taxes, anything else modeled in the projection. This is also inflation adjusted over time. We can also enter additional expenses. So if you want to itemize out some major goals that they're working towards, or if there's one-off or temporary expenses that you want to include. So in this case, we're going to do some additional travel of $10,000 per year. We'll adjust that with inflation, and we'll run that from age 60 until 74. We can then highlight this in the reports so that it's itemized and included in the legend so that we can highlight the fact that it's been covered in the plan. You could add other expenses. So if the client wants to do a major renovation or they're going to give a gift to their children, you can model that in here. Now that we've set the expenses, we'll click next and go to the incomes page. Melissa is currently earning $140,000 a year, so we'll update her salary here. By default, it's set to indexing as 0 for conservative assumptions. You can clear that value if you want to link it directly to the general inflation rate in the plan, or you could apply any other indexing rate that you'd like. In this case, we'll link it for cost of living. This is being entered as employment income, so Snap will automatically deduct CPP and EI. It will tax it appropriately, track RSP eligibility, and then run until the end of the year in which the client turns 59. We can prorate income if we want. So if they have a specific target retirement date in mind, we can enter that here, and then Snap will apply a prorated portion of income for the last year. We could enter other incomes. So if the client had a rental property or they're going to receive an inheritance, we can enter those lump sum or ongoing incomes here. Again, selecting whether it's taxable or not, whether it's earning RSP room. We can also enter pensions. So she has a defined benefit pension plan that will start when she retires at age 60. The pre-65 benefit, including the bridge, is $35,000 a year. There's no guaranteed indexing. And then once the bridge benefit drops off, she'll receive $27,000 a year from that point on. Next, we'll go to the assets page. You'll see there's a non-reg default account added as an example. I'm just going to update the title to non-reg. She has a current balance of $160,000 with a cost base of $140,000. And that's invested 30% fixed income and 70% equity. And you'll see that Snap has pre-populated the rate of return assumption for each account based off of our default settings. That arrives at a total portfolio return based off of the asset allocation. And we can customize the rate of return on an account by account basis. So if the client is invested in a GIC or some other product that has a different expected rate of return, we can adjust those accordingly. We can also add other financial assets. So she has a tax-free savings account with $120,000. And she has an RSP with $325,000. Now that we've added the accounts, you'll see across the top of the table, there are tabs for each of the registered account types. And this is a common theme throughout Snap. You can get started with quick and simple projections using base conservative assumptions, or you can come into these settings pages and customize the plan assumptions to tailor it more to your client's unique circumstances. So in this case, if the client has a bunch of carry forward room for their TFSA, we could enter it here. We can also turn on an automated tool that will top up the TFSA from non-registered balances if available. We'll show how to use that in one of our scenarios later on. If we go to the RSP tab, again, we can customize the carry forward room, enter in pension adjustments if it's applicable, and then set the conversion age for the RSP to RIF. I'll go back to the assets page, go down to the real assets and input her home, which has a current value of $750,000 and original cost of $450,000. You'll see that we can model a future purchase. So if a client's saving up for a home or going to buy an investment property, you can model that here. If they're going to downsize, you can enter in a future sale age, and you can have multiple properties in order to show buying and selling, or if they have multiple in place already, you can indicate if there's capital gain tax applicable to any of the sales. Clicking next, we'll go to the debts page and enter in the remaining mortgage, which has a balance of $150,000, interest rate of 5%, and monthly payments of $1,600. We can link that under the real asset column to the home. So if we sell the property at any time before the mortgage is repaid, Snap will automatically finish off the balance before using the proceeds for any other purpose. On the government benefits page, we have the ability to enter in the target start age. So it defaults to the date of retirement. We can update that here. We're going to assume 65 for our base scenario. And then you'll see that Snap automatically assumes the national average benefit. So because it doesn't have all of the historical contribution information, it assumes national average, and then you can adjust that here. So if you know the dollar value that they're currently receiving or expected to receive, you can enter that information. Or if you want to estimate what they'll get based off of their years of contribution, you can enter in a percentage of maximum here, and Snap will calculate the expected benefit. For OAS, we have similar flexibility. We can set the start age and then enter in a dollar value or percentage of maximum. And with that, in less than 10 minutes, we've entered in all of our scenario setup data for Melissa. You'll see on the left that we do have other pages available as needed. So if you wanted to enter in insurance policies, you could do life, disability, or critical illness. You could enter in RESP information, customize additional settings, or add corporations to the plan. For now, we're all finished, so we'll click Planning Pages in the top left. And that's going to take us to the main section of the software where all of the data that we've entered so far will come together to show us Melissa's life on one page. Now, the planning page can seem overwhelming the first time that you see it, but it's a very powerful section and quite intuitive once you get to know what it's providing. On the left, we have the year and the client's age. Then we have the discretionary cash flow. So this is what's left over after accounting for everything so far in the plan. This 81,000 is calculated by taking 140,000 of employment income, subtracting off CPP and EI of about 6,000, taxes of 34,000, and mortgage payments of 19,000. So everything that's been entered so far has been accounted for, and that leaves the client with 81,000 left over. And that can either be used for spending or savings. Now we have two options available for making savings in Snap. We could either set their target spending to that 60K target, and Snap would automatically allocate the surplus into their investments. Or what we find to be typically more conservative, we can actually enter in their contributions directly and just assume that they're spending the remainder. So in this case, Melissa's maxing out both her TFSA and RSP and then spending whatever's left. To max out a contribution to a registered account, we can simply contribute a large balance. In the top right, you'll see the Run button has turned orange. And when we click that to apply the change to the projection, Snap is going to attempt to contribute 10,000 each year, and it's going to stop at the projected maximum. So now we've maxed out the TFSA. We can do a similar approach for the RSP, just enter in 50,000. And when we run the scenario, Snap is going to index the expected future contributions based off of the client's employment income. So now we've maxed out their two registered accounts. If we scroll back, now we can see that the software has calculated that they have about 60,000 left over for spending purposes. That process continues all the way until age 59, when the employment income stops and the retirement target begins. So here we have 60,000 indexed for inflation. We have our travel goal, and then we can see how that's being funded. So there's the pension that starts at 60 for 35,000. And then Snap is automatically withdrawing from the financial assets in a tax efficient manner in order to help fund those spending needs. And those withdrawals continue all the way down throughout the projection. And then in the final year of the plan, we can see that there's a little bit of buffer left. There's about 128,000 left in the RSP as of age 100. So at this stage, we can say that Melissa is on track for her goal of retiring in 10 years, assuming she continues to max out her accounts. We may be able to make some additional recommendations and optimizations to the plan, but just at a high level, she does appear to be on track. In addition to the planning page, we can also review all of this information in the form of charts. So at the top of the page, I'll click charts. Here we have the cash outflow. So this is showing where Melissa's money is going each year, whether that's her base spending of 60,000, the additional travel, income taxes, debt payments, or contributions to financial assets. We can see where her money is coming from, whether it's employment income, pension income, government benefits, or withdrawals. And then we can see how much she has available across different assets over time. And all of these charts are fully interactive. So if I were to click on the real assets or the net worth, I can create a financial view of just her liquid assets. And then I can also hover my mouse over top of any of the years and get additional information broken out. So now we're finished with the first scenario. So we can go back to the list of questions and figure out where we're going to go next. So how long will my money last? Am I going to be okay? Yes, she'll be fine given the assumptions that we've entered in the projection. For answering her next questions around what's the maximum that she can spend, when should she take her government benefits, what assets should she use first, we're going to create a couple of alternative scenarios with different decisions related to these options, and we'll show which plan is the best for her specific goals. So we'll go back into Snap, and we're going to start by renaming our first scenario. So at the top, you'll see currently it's called base scenario. We can click on that and then update the title to scenario 1, base case. Then using the menu, I'll click the 3 horizontal white lines, click copy scenario, and we can run an alternative case where Melissa defers CPP and OAS. So this will be scenario 2, defer CPP and OAS. And now we have 2 versions of the plan, our original and an alternative. To make the change to government benefits, we just go back into scenario setup and down to the government benefits page. We can change the start age from 65 to 70, and Snap will automatically recalculate the expected pension based off of the deferral bonus. We scroll down, we can make the same change for OAS. Now going back to the planning page, we'll be able to see the update and impact on the plan. So now we've got a full decade at the start of retirement with no government benefits, and Snap is just making extra withdrawals from the financial assets in order to fill that gap. Then as we scroll down towards the bottom, we can see the impact on the scenario. So now there's 125,000 in the RSP and 280,000 in the TFSA. So just based off of a longevity consideration, if Melissa's primary concern is outliving her money, deferring CPP and OAS would help protect against that, because in the case that she lives longer, she'll be better off by receiving those increased amounts starting at age 70. However, this may not be the final and most optimized version of the plan. If we go back to the start of retirement, we'll notice that there's fairly limited taxable income. So there's some non-registered investment income and some pension income at the start, but it may be possible to do more of a blending in this initial period, taking some money from registered accounts, some money from non-reg, in order to smooth out her taxable income and pay lower total taxes throughout the plan. So that'll be our next scenario. I'll go back up to the menu and click copy scenario. Once again, I'll click on the title and rename it. So this will be scenario 3. We're still going to keep the CPP and OAS deferral, but now we're going to use a new tool in Snap to actually target a specific level of taxable income. So we can tell the software, I'd like $50,000 a year of taxable income, and it will generate enough from the available registered accounts in order to meet that threshold. And that's going to allow us to stay within certain tax brackets or avoid clawbacks on credits or OAS benefits. And then we'll also show how to use that TFSA top-up tool that I mentioned earlier. So we'll save the title and we'll go into the planning pages. For the first step, we'll go to the taxable income column. This is where we can see how much taxable income the client has each year. And we're going to click on the gear symbol. Once again, this teal blue box, click on that, and we're going to turn on taxable income targeting. And this is going to create an optional new column for us where we can set a target level, and then Snap is going to work towards that amount. So in this case, we're going to use the 50,360, and we're going to do that every year of the plan. And then I'm also going to indicate that this figure, the 5360, is based off of 2026 tax brackets. So because tax brackets are indexed for inflation, we want to reach a higher level of taxable income once she retires in 2036. So Snap is automatically going to calculate what that expected bracket will be. So now I'll hit the check mark. The expected taxable income for the top of the lowest bracket in BC will be 61,993. And now we'll run this scenario so that Snap can actually generate that amount of taxable income. So now you'll see the target is equal to the actual, and we can see where Snap is getting it from. So it's taking the perfect amount from registered and then the rest of the money out of the non-registered account. And now if we scroll all the way to the bottom, we can see that that has further enhanced the outcomes for Melissa. So now there's about 500,000 left in the TFSA instead of 0 and about 200K in the last two scenarios. But in addition to being able to compare scenarios from the planning page, we can also use a dedicated feature for that called Compare Scenario. So we'll go to the menu, click Compare Scenario, and now we have the three plans that we've created so far. And so we can see at a very high level, this metric that we call goal progress is how much of the client's spending is funded through liquid assets in the projection. So here we had 102% in our original case. We had a little bit left over in the RSP. Then we increased that to 106% funding by deferring CPP and OAS. And then we increased that a further 2% through the tax optimization. And sorry, I forgot, if we go back into the tool once more, in addition to the taxable income targeting, we can turn on the TFSA top-up feature. So I'll go back to the assets page, and I'm going to maximize TFSA contributions for this scenario. And so now if we look, the software is automatically pulling extra money out of the non-reg for as long as it lasts and putting that money directly into the TFSA based off of the maximum allowable. So it's just further tax optimizing the plan in order to reduce the total paid on non-registered investment income. And now we can go back into that compare scenario, and we can see what's causing the improvement. So here we have lifetime personal taxes. So in the first scenario, it was about $1 million. And then by deferring government benefits, we increased that to about 1.1 million. And then by creating the taxable income target, we dropped that back down to $1 million. For lifetime government benefits, we increased from 1.7 to 2.1, and then we got to keep the best of both worlds. So full government benefits with less taxes payable. And then we have the total financial assets in each plan, and we can see that that gradually increases, and that's what results in a higher net of tax estate in each of the three scenarios. Now, this is just comparing the plan at the end of the projection as of age 100. We can also look at the comparison over time through charts using the Trends tab of the scenario comparison. So now we have the personal estate after tax for our three plans in each year of the projection. And if we ignore scenario 3 just for a moment, I'm going to unclick it. We have scenario 1 and 2. So with scenario 1, we have CPP and OAS starting at 65. And we can see that because of that, we're better off with scenario 1 up until the client turns 85. So this is specifically tailored to this client's plan, their tax rates, their available resources. And then after age 85, we can see that they would be better having deferred government benefits. So this is a typical case with multiple options and decisions. There's usually some sort of trade-off. If you live from 65 till 85, you're better off going this way. But if you live past 85, you're better off with the other option. When we introduce scenario three, we've done so much optimization here that we're actually better in all circumstances except for 1 year by a very minor amount. So here we don't have that trade-off of, depending on when you live, you'll be better off with this case or this. So this is kind of the ideal state. If we can get to a scenario that's better in all circumstances, we can very confidently recommend that and have the client be best off going forward. So we'll recommend scenario three in this case, and the next step will be to create a custom report for that plan. Before we continue on, I just want to highlight that a lot of the features that we've used today, the TFSA top-up, the taxable income targeting, the CPP automated age change and benefit adjustment, those are all new features within the last year. And this is all in an effort to continue moving towards automating this whole process. So we recognize that there's quite a few steps to do this process, and we want to save you time while still giving you the same level of control and transparency that's available today in Snap. So the next phase of this series of releases is a dedicated optimization tool that will run multiple combinations of these settings. So without you having to turn on the taxable income targeting and set a target and top up the TFSA, Snap will just do that in the background and then let you know what the best combination out of the series of projections created is optimal for your client's case. And then you'll still be able to go in, review what the results are in the plan, what steps the client would need to take in order to implement that, and then make any adjustments that you still want. So you could still override specific accounts. So if you don't want a certain non-registered used at all in the plan because it's meant as a gift to grandkids, you can just tell Snap not to use that account. So you'll still have the same level of customizability as you do today, but with that huge time savings of the automated optimization process. Now that we have the optimal scenario in scenario three, we'll create a client report in order to help address the 6 questions that Melissa has. To do that, we're going to click on client report in the top left. And then in the top left again, we'll see report builder. Now, by default, when you create a new Snap account, you'll see all of the available pages in the report. This is just to give you a sense of what charts and tables and comment sections are available for you to use as needed. You don't have to include all of the pages. Typically, it's more than a client can really consume. And so you have options to customize the report in order to create a more tailored or focused summary of the plan. One of the options available is to use our snapshots tool as a single 1 or 2 page summary of the projection. So when I click snapshots only, you'll see that the other pages are grayed out and it's just focused on these snapshot summaries. There are 10 summaries in total available for you to select from, things like the goal status, goal summary, expense summary, and you can pick which 6 you want if you want to do a 1-page, or you can use all 10 if you want to do a 2-page summary. In this case, we're going to do a 1-page summary with 6 total charts and tables. And so I'll just pick the 4 that I want to remove. So I'm going to get rid of assumption summary. I'm also going to remove the financial asset flows, the net worth summary, and the expense summary. So once I've clicked the pages, I can either hit delete on my keyboard or I can just drag those over to the gallery on the right where I'll have access to them in the future if I need. So now we've got just 6. And we can go to the report editor in order to review the information that's included on each of these pages. So I'll click next and go to the goal summary. Here we have Melissa to retire at 60 in 2036. We can see her average spending before retirement and her average spending in retirement. And all of these values are referencing specific variables. So they're not hard-coded text that you need to update over time. These are referencing specific values or variables in the software that get recalculated every time that the plan gets updated. So if you make an update to the projection in a future year, everything will flow automatically into the report. You can also delete bullets if you want, so you can highlight and remove, or you can enter in your own comments as needed. So here I'm going to say additional travel budget, starting at, and then on the right, I can use her variables. So at age, retirement, in, and then retirement year. So now if I update the retirement in the future, these values will automatically adjust. I'll click next and go to the goal status page. So here we have that 108% funding status. And then we have a box where we can enter in options for the client to consider to use up that surplus. And this actually pulls directly from the recommendations tool that is available on the planning page. So if I go back to planning pages and I click on recommendations at the top, we'll see that 108 figure, and then we'll have the ability to calculate things like retirement age, sustainable spending. And this is just telling us what the client's maximum annual spending would be if they wanted to use up that extra 8%. So in this case, they could bump up their spending from 60,000 to 63 if they wanted to use up all of their liquid financial assets by the end of the plan. And now that we've calculated that value, when I go back into the client report, it's going to be automatically included in the goal status. So you can select which ones you want, calculate them in the recommendation tool, and then they'll be part of your report. And we can again add our own bullets. So leaving a larger estate. Then we've got the net worth summary, which shows how much she'll have across various asset categories. We can see where her money is coming from at a high level, how much is expected to be left at the end. And then we have a recommendation summary where we can enter in our own custom text. So I've already drafted some language. So we're just offering some congratulations on the success so far, recommending to continue maxing out the TFSA and RSP, and then confirming that she'll likely want to defer government benefits to age 70, taking registered money early, and that we'll revisit those calculations closer to the actual retirement date in order to apply any updates for government benefits and things of that nature. So now that we're done with the report editor, we can take a look at the resulting preview. So we have the goal summary, goal status, all 6 of the tiles that we had initially. So this is the exact same deliverable that we showed at the beginning of today's demonstration. So you can export this as a PDF and then share that with the client, store that in your files, and then use this as an updated template in the future as needed. So now that we've got the snapshot, we can use it to answer the 6 questions clearly and confidently for the client. So going to the first one, how long will my money last? Am I going to be okay? We can address this through a number of charts and tables. So we can see the net worth is significantly positive at the end of the plan. We can also see the projected nominal and real expected estate. How much can I spend so I won't run out of money? That would be taking her target of 60,000 a year and then adding 3,000 additional, which is the buffer available in the plan. So 63,000 would be the maximum. When should I take my government benefits? In this case, we've confirmed that she'll likely want to defer given her concerns about longevity. If she had shorter life expectancy or other concerns or goals, then we would be able to factor that into the recommendation that we make. Which of my assets should I spend first? We've confirmed that she should use registered accounts up to her first tax bracket and then use non-reg and TFSA money to supplement that. I'm currently saving X. Will it be enough? So yes, we've shown with her 10 years of ongoing maxed out contributions, she would have sufficient investments to see her plan through. And then how much will be left after taxes for my beneficiaries? We have the estate information here with the gross taxes and net of tax figure. Depending on what the client's situation is, if they had a cottage with a deferred capital gain or a large investment account at the time of death, then the tax on estate would be calculated appropriately. It would be reflected here. We also have the estate after tax. So this is in future dollars, how much her beneficiary will actually receive. And then the real dollar is adjusting that for inflation back to today. So basically saying they'll get 2.7 million, but it's really the equivalent of about $1 million in purchasing power in today's world. Now, these are the 6 most common questions that we've come across over the years, but depending on the type of clients that you work with, how old they are, what the stage of life is, there's lots of other questions that they might have. Should they invest or pay off their mortgage? What happens if returns are lower than expected? What happens if inflation is higher than expected? Do they have enough insurance in place? So there's lots of other tools that we have not highlighted today in the software to help you address these other questions. So if we go back to planning pages for a moment, you'll see that we have things like stress testing, which allows you to use historical or randomized rates of return in the scenario in order to illustrate what might happen if returns or inflation are different than expected. You can also run needs analysis for life, disability, and critical illness to see if there's enough coverage in place. You can add in corporations or other considerations that they have in their plan. And again, we can always use that scenario comparison tool to compare one plan to another. So here's what happens if you invest. Here's what happens if you pay off your mortgage. And then what are the outcomes and what are the pros and cons for the client? With that, we do have some support materials for all of those features. So if you want to learn more about stress testing or needs analysis, the moment that you sign up for your free trial, you can go to the help site in the top right, click on Help Center, and then you'll be able to access all of our previous webinar recordings that are still relevant to the software. So if you look at webinars, you can see things like presenting Snap to your clients, a refresher on the newest features, modeling insurance coverage. You can also search for key terms like inheritance and how to enter that into the software. And if you ever get stuck, you can give our team a call directly, send us an email, and we'll be happy to help on a one-on-one basis with your case. With that, I'm going to pass it back to Alex so that we can walk through a few next steps and then we'll open it up for questions.
Fantastic, Steve. Thank you so much. So, as Steve just said, we have covered a lot this hour, but we are here to address any and all questions in just a moment. For those of you here today who are already using Snap, thank you so much for making time to be here with us today and for being a valued member of the Snap community. A reminder that you can be earning free months of Snap when you send referrals our way. This program is win-win. The referred advisor gets 50% off their first month of Snap, and the referring advisor, that's you, gets an entire free month of service when the advisor you sent becomes a paying user. If you are on annual billing, you will receive a $100 credit against your next renewal. There is no limit on how many times you can do this. 6 annual referrals would mean getting Snap free for half of the year. We have created a referrals page that you can access from within your Snap account that makes it easy to earn free months. Now, for those of you here today who cannot benefit from the referral program, we've got a special offer to help you get started with Snap. We are going to give something to every single advisor who signs up for a free trial today. Each one of you who starts before midnight Eastern time today will receive an extended 1-hour onboarding and training session. Plus, we will set up your report branding for you, and we will help you to create and save your own personalized snapshot template, just as you saw Steve do here today. The snapshot is very flexible, but it's most often used in 3 different ways. There we go. It can be used as a standalone client deliverable that essentially replaces the longer client report. It can be used as a 1 or 2-page quarterly or annual review, and it can be used as the executive summary to the full comprehensive report. The beautiful thing about this is that once your template is created, your snapshot is automatically built from the data within your projections. No extra work is required to produce this report. As part of this special package today, the support team will work with you one on one to create your template so you can instantly pull a 1 or 2 page report from your projections. On our pricing page, you'll see there are 2 plans for you to choose from as an independent advisor. The advisor business is the plan you want if you need access to the corporate module. You can upgrade and downgrade easily, so don't worry too much about which one you select today for your free trial. If anyone would like to see the corporate module, let me know and we will try to cover that in the Q&A. I've already dropped the link in the chat, which is what you can use to create your Snap Projections account, get instant access to the software, and ensure you get to take advantage of the special onboarding and training package being offered to everyone who starts today. Please click that link now so you have the window open on your device before the session closes out. And I will be sending these out via email as well. Okay, so with that, we have got lots of time for your questions. So keep those coming in. We've already got a bunch that have come in through the hour. So the first question, Steve, is how can we have the expenses less in retirement compared to the working years?
Great question. So what we can do is a number of things. The first would be to just directly change the target spending as of age 60. So if we wanted, if we see that they're spending 60,000 a year before retirement and we want to drop that down a bit, we could just enter in their target spending here and copy that down for all future years. So we can make edits directly on the planning page, or we could always go back to scenario setup and make the same change here. Making it here will apply it to all years of the plan, but on the planning page, we can actually do it in tiers. So one thing that people will sometimes talk about with retirement is the idea of phases of spending. So maybe you want your initial spending for the first 10 years, so 60,000, and then as of age 70, that's when we'll drop it down to 50,000. So you can do different tiers or periods of spending in the plan in order to illustrate the client's needs directly in the software. One thing that I do want to highlight, though, is just to emphasize that this spending amount in Snap is net of all other transactions in the software. So this is net of mortgage, net of contributions, net of taxes. This net figure does not typically change that much when you retire. When people talk about dropping spending in retirement, it's usually because they're thinking of gross income that is already being accounted towards things like mortgage and savings. And so you don't need all of that in retirement to meet your spending needs. But Snap intentionally strips all of that out to try and make these periods as comparable as possible. So if you do need 58,000 a year today, net of mortgage, savings, taxes, then you would need to cut something out of your current lifestyle, hobbies or travel or something, if you wanted to drop it in retirement. So the way that Snap is structured is to try and provide a consistent framework for the spending needs net of all other transactions in the software.
Fantastic, Steve. Thank you. Okay, next question. I've been using NaviPlan for 20 years. Is there a way to import my existing cases into Snap?
Great question. So the exciting news is that we just launched a new tool that would help with this process. There is not a direct integration with other software providers, but because of the common use case of wanting to bring data from another system, be that your CRM, another software, we've created a new tool in Snap called the AI Import Assistant. So when I want to create a new client, I can either do that as I showed today, personally or manually, or I can click on the drop down and then import that with AI. So what I would do is I would upload the document, so your export from Navi in this case, or your export from your CRM, or your client questionnaire, or whatever else, you would upload that to the software. Snap would go through it, use its AI tool to populate all of the scenario setup fields that we saw today, and then it would create a summary of what it did in the software. So the great thing about the tool is that it lets you know what it did, what it didn't do, and then you'll be able to go through the scenario setup and review that information and then make any additional next steps required or recommended. We do have an article about that new tool. So if you go into Help and then Help Center, you can look for AI Assistant. And there's a 10-minute highlight video just overviewing how it works. So if you're interested in bringing over a large number of existing projections, or you want to use this for your standard plan creation, you can do so. We are in the process of expanding this functionality. So we've made quite a few enhancements based off of feedback and continued use of the tool. And we'll also be looking to add additional options to get more capacity in terms of the number of AI-based plans that you can create. So very exciting. If you're interested or you have any questions, please feel free to let us know.
Fantastic. Thank you. And so a few questions for the corporations, asking just to see a general overview, and then more specifically, we've got one here that says, we are interested in learning more about how you can merge a corporation with personal data. We plan for a lot of business owners. Does Snap do this seamlessly?
Okay. So yes, if we're in our new scenario 4 for the Q&A period, we would be able to add a corporation to the plan. And this would be you have the option to do this as a standalone operating income or operating business. You can do this as a holding company, or you can actually do them both within the same corporation. So if the client has both an active business and a holding company, you can model that all within one single corporation. It's going to connect for the retained earnings to go into the holdco. It's going to make sure that the notional account balances that are generated are tracked and usable. So I'll show how to set that up, and then if there's any additional questions, please let us know. So the first step, similar to on the personal side, we have this scenario setup. So you'll see we can enter in things like the corporate settings, assets, debts, insurance. For the corporation, we can customize things like the small business deduction limit. We have the notional account balances. If you don't have this information available, you can leave these values 0. It's just going to create a more conservative case than if you included those tax saving tools. We have the ability to customize ownership and the disposition assumptions, when the corporation is going to be disposed of, whether it's going to be a capital gain or a distribution of dividends. And then we can enter in things like investments. So if there's a holdco with 500K, we would have that here. We could enter in real assets. So if there's private companies within the holdco, or real estate or other assets, we can enter that here. If there's any debts, we can include them. We can enter in corporate-owned life insurance. And then once we're done with this scenario setup, we would go to the planning pages for the corporation. And this, as I mentioned, is where we would have the opco information. So if the client's earning, say, 300,000 in an opco until age 59, and that'll be indexed. And then they might be paying themselves their salary out of their corp. So if we do this, we would just get rid of the personal salary that we included earlier, and we would have the salary coming from the corporation, and that would automatically create the cash flow on the personal side. And then they might have 50,000 of other deductible expenses. So now we've modeled the opco. That's going to tax that at the small business deduction rate because it's below 500,000. If the passive investment income ends up being more than 50,000, the small business deduction would automatically get clawed back, and you'd have GRIP being earned and the full corporate rate applied. So all of that is automated in the software. We can see that the Net income is 110,000 and then taxes of 18. So the deposit to the holdco is 91,000, and that process of retained earnings being deposited to the holdco continues until the end of work. And then they've got about 2 million in assets that they can use either to hold within the corporation. You could show an investment into a whole life policy. You could show distributions using dividends. So in this case, maybe they'll pay out 100,000 per year of dividends until the corp is depleted. And I can do that very simply as a non-eligible dividend to be conservative, or I could use the notional account balances here in order to pay out things like capital dividends, use the GRIP to pay eligible dividends, and then you'll see that Snap is automatically tracking and redeeming eligible dividend refunds as applicable. So quite comprehensive on the corporate side. Once you're done with all of the corporate planning, when we come back to the personal side, we'll see everything gets automatically integrated into the plan. So here we have the corporations section. We can see the salary coming in. We can see the dividends. And now that dividend income is being included in the client's available resources. So they're no longer taking withdrawals out of the non-reg. We can see that they're actually contributing to the account because now they have much more cash flow than they need. So what we could do is go back into recommendations and then calculate their sustainable spending now that we've included all of these corporate assets. So now they could spend about 99,000 a year instead of the original 60,000. So that's the corporate module and how it interacts with the personal side automatically.
Fantastic, Steve. Thanks so much. And we have got numerous training videos on this as well. That was, just a very quick high-level explanation. And so I've got two questions here you can probably answer at once. How does Snap use DRIP versus not reinvesting dividends? And for non-registered portfolios, how does the software identify different types of income, i.e. dividends, capital gains, etc.?
Great question. So for the first one related to DRIP versus distributions, the assumption at the moment in Snap is that all investment income is initially reinvested, so it's DRIPed, and then any withdrawal would come out of that new principal balance. So there are ways in Snap to model, like if a client has a large dividend portfolio that they're pulling the dividends out for spending purposes and they're not making any withdrawals, we can model that through an alternative approach, but the default settings is for all investment income to be DRIPed and then all withdrawals to come out of the principal. The way that we control the tax settings in the software is a combination of the asset allocation. So if we go back to this non-reg, we can see that 30% of the portfolio is in fixed income. So that's going to generate interest income. And then 70% is in equities, which will give us the option to set how much we want coming from capital gains, Canadian or foreign dividends. So the way that we control the equity allocation is through one of the settings pages that I mentioned earlier on, called portfolio settings. So here we have the default in Snap is 60% capital gains, 20% Canadian dividends, 20% foreign. And then there's some portfolio turnover that is crystallizing some of these deferred capital gains on an ongoing basis. So you can customize these to more closely align with your client's specific portfolio. So if they don't invest in foreign dividend paying stocks, you could set this to 0 and reallocate that elsewhere. And as you make changes to the portfolio settings, you'll be able to see the impact on the taxable income by going to the taxable income section of the software and then clicking on the blue box with the lines in it. So this is going to give you a more detailed taxable income summary. So here we can see the interest, foreign dividends, Canadian dividends, and capital gains assumed each year of the plan. So as you adjust your portfolio settings, you'll see the impact reflected here.
Perfect, Steve. Thank you. Still a bunch of questions we haven't gotten to, but we will just try to squeeze one more in quickly here. How do we set the order of savings from excess income? For example, TFSA first, non-registered second.
So we have a tool here, the teal blue box, that allows us to customize the savings and withdrawal order within the software. So if we look here, by default, Snap will contribute surplus into the registered accounts. If there's room and there's still an RSP in the plan, then it will do TFSA, then it will do non-registered. And then for withdrawals, it'll do the reverse order, non-reg, TFSA, RSP. And you can change that for one single year of the plan if you want, or if you want TFSA, then non-reg, and you don't want to make contributions to the RSP, you would change it here and then copy that down for the length of the plan. So now it'll just use TFSA and then put the rest into the non-registered account.
Fantastic. Thank you, Steve. Well, everyone, we are out of time. Thank you so much for being here live with us today. And I hope this has been a valuable session for all of you. Please watch for a few emails from me. The one coming out tomorrow will include the form to fill out to request the CE credit from today's session. And today I will be sending out what you need to get entered in to win the 1 hour onboarding session that everyone will get who signs up for a free trial today. Enjoy the rest of your day, and I'm looking forward to continuing the conversation offline. Bye for now.